Welcome to the 10 Mil Club Standard Portfolio video for the first week of August 2026.
From the South Carolina Low Country,
It's the 10 Mil Club. It's the 10 Mil Club.
The 10 Mil Club is a group of informal group of people who believe that if we could get to $10 million of net wealth, we would have the financial freedom we're looking for. We didn't have a 10 Mil Club video for the fourth week of July 2026 a week ago. Apologies for that. We were at a family reunion in upper central Washington state in the mountains, and we were just a few miles south of one of the gigantic forest fires. We keep referring to it as being in fire country for the week. But we honestly, that wasn't really the factor. The factor was we couldn't get any Wi-Fi that would upload a video. So apologies for not hearing from us, but we're we're back on track now. The week, or 2 weeks as it were, starting with the VIX. So looking back, the VIX was a bit higher when we kind of left for fire country. It's lower now. Now 14.90 is really low for the VIX. The VIX is the volatility index. We could go into some nuance on it, but it generally shows the volatility on the surface, and this is important, of the market itself. For the S&P 500, which is usually viewed as a proxy for the market itself, which has some complications of its own. But 14.90 is really low. Now, here's an interesting thing. The CFA program, which I have been through and completed, teaches that there's almost any way for you to get, even as a small retail investor, there's almost any way for you to get exposure to something that a lot of times even just the big institutional investors can get. There's always a way. There's almost always a way to do that. You just have to kind of go around your little finger to get to your thumb to get it. The VIX is one of those things. Now, let me show you this. And you would think, so it's interesting. The VIX is a measure of volatility. It's not really an asset of its own right. Switch over to 2 years of the VIX real quick. You can actually see just how low 14.9 really is. Not the lowest it's been. I guess if you get back over here, we get a VIX that's 14.45, somewhere in that area. Back over in this area, we get a VIX that's in the 13s, truly in the low 13s, even bumping the high 12s. But that low, 1490, is really, really low. If you were a wily trader and you really wanted to figure out a way to trade this, now admittedly, we don't quite have an absolute low quite yet. I mean, you could cut it anywhere you wanted to. It's up to you. But if you wanted to do something that looked like this, we actually don't have a turn yet. But there are options on the VIX, and you do actually have the ability to trade the VIX. Of course, with it being low, every CFA question begins with a trader believes that, or an investor believes that, or an economist believes that, and then they teach you how to handle that, which is what's interesting about the CFA program. It's really all about teaching you how to handle what you know. Figuring out what you know is actually outside the scope of the program in general. There's a little bit of figuring out what you should know, but in general, it's teaching you how to handle what you otherwise should know. And unless I missed the CFA program, if the people who signed my certificate, actually Margaret's not with the CFA program anymore, but she's not the CEO anymore. But if anybody on the board or anything is watching this video and I completely missed out the point of the CFA, you're welcome to let me know and chime in. We would love to hear from you. And if I could, just for a quick second, please give our video a like. Give us a thumbs up. Consider subscribing. We try to do this every week. Obviously, we didn't last week. we got a comment on one of our videos, and we answered it. There's also a Facebook page and a Facebook group, and I will put the links to those down below once this video is uploaded. Not in real time, but at the end of every trading day, we put what we did or thought at the end of that day. I just don't have time in real time to post exactly what we're doing, but we have found that telling you what we did after the market closed that day, going into the next day, actually, sometimes we're up, sometimes we're down, sometimes we're sideways. It really doesn't have a whole lot of, I mean, we're position traders, and so we're not too terribly worried about a few hours one way or the other. A lot of things we buy just before the market closes anyway, because it's not quite as volatile as market open. So anyway, there is a way to trade the VIX, and one way is to either, if a trader believes that the VIX is low and would go up, the easiest way to do that would be either to sell a put option, or probably in our case a cash secured put, or to buy a call option. If you sell a cash secured put, you put theta on your side, theta decay on your side. If you buy a call, you end up putting yourself short theta decay, or on the quote unquote wrong side of theta decay. And if you don't know what I'm talking about and that goes over your head, it's totally okay. We actually don't use a whole lot of options here at the 10 Mil Club. We we do use them here and there, but they have their own complications. Anyway, just a side note, if somebody wanted to know that you actually could trade the VIX, this is very low. It could go lower. That's fine. Interestingly, though, the way the volatility in the market's working, and if you have watched Dave Keller, as we do religiously, I totally recommend Dave Keller's Market Misbehavior YouTube channel and show. In fact, watch him before you watch us. We're just a bunch of people who are trying to put letters after our last names and learn this stuff as well as we can. He's been doing it for decades, and he has a better market overview than we will ever have. So we're basically doing kind of a stripped down version of what he has in the market overview section, and then we do our own portfolio stuff that won't necessarily coincide with his unless it's just by happenstance. But what Dave's been saying is that it's a very placid market on the surface, like with the VIX here. But underneath the surface, there's a lot of rotation going on in institutional money moving from one sector to another as the market kind of rotates. And so it can be very violent underneath the surface. And we're trying to capitalize on that. In some cases, we've done it a little bit that's in a pleasing way to us. And you'll see that when we get into the portfolio stuff. The MOVE index is generally considered the VIX for, sorry, that's way too close. So here's a year of it. MOVE index is generally considered the VIX for the bond market generally being the smarter money, or at least the less volatile money. It is not, it's down, but it's not as low as the VIX, and it doesn't go in perfect synchrony with the VIX either, but it's low as well. 72 really isn't very high or elevated. You know, we don't have anything that looks like this, like when the Iran war broke out. But anyway, not a whole lot of problem going on there. The two breadth indicators that we watch, and there are tons that really we should be watching, things like the Chaikin Money Flow Index and the Cinnamon Index, the McClellan Oscillator and things like that. We should be watching that, but we just cover two here so we can get on with the show. This is the percent of S&P 500 companies trading above their 200-day moving average. We're at about 72%. That's pretty high. If we go back 2 years, 72%. We have been higher, like back here in late 2024. But this is getting up there pretty good. That is pretty strong breadth in the market. S&P 500 companies over their 50-day moving average itself is 65%, which is also pretty high. Can go higher. Market can decide that's too high anyway. But there we are. And a lot of these things, these are just, don't worry about the 200-day moving averages and things. I don't think they really reflect a whole lot on this. So that's where we sit. we'll check in real quick on, we watch SPYM here. This is 2 years of it. Let's go to more like a year. Okay. SPYM, VOO, SPY, these are ETFs that follow the S&P 500. We watch this one, SPYM, only for the share price because it's $91 a share, and it moves pretty much by the same percentage as those others. You can just buy more shares of it. So we like this one a little better just because it's kind of a mini S&P 500, but it's supposed to follow the market exactly the same way. If you pulled up VOO, you'd see exactly, or SPY, you'd see exactly the same thing. Did have a breakout here, and we are cupping right there. So at the moment, it's looking like the S&P 500 is planning to move higher. All that happened while we were in fire country. So with that going on, we're kind of paying attention to where we should go from here. It looks like kind of a risk-on market, despite the fact, and we don't ever pull this graph up, and I'm not going to do it right now, but the market is greatly overvalued compared to historical norms. Like the market hasn't been this highly valued in a really long time. And maybe on a future show when I don't have so much to cover, we'll go over that. The truth is your returns may not be all that great going forward, which is why we're doing so much active trading here, is that we figure we kind of need to create our own opportunities. Real quick, there are two here. SH is the short S&P 500 way down. That's obviously going to be basically the inverse of SPYM, and then PSQ is the short NASDAQ. Both of them are down, and both are showing negative momentum. Don't go short right now. Even if you look at it and you think, well, this is a really placid market, and I'm going to go short because I think the S&P 500 is way too high. Don't do that. You will probably get killed because markets can actually stay irrational for a lot longer than you can stay liquid, and those aren't my own words. Were they Jesse Livermore's words or something like that? Maybe it's I have to look it up. All right, so placid market seems to be upwardly moving, and not a whole lot to take us risk off. So with that, let's get to it.
10. Milk Club.
ABM we still own, and we have for just a little while. It's above its 21-day EMA. Quick note here, if I might, I'll pull into about 3 months one day. All right, what I have on these lines are me drawing lines that eventually get deleted and stuff, but this one right here is the 21-day exponential moving average. We watch that because we like to own stocks that at least respect that 21-day moving average. It gives us our first red flag before it breaks below the 21-day exponential moving average. On whatever trading platform you're using, you should be able to overlay a 21-day exponential moving average. Yellow one is a 50-day simple moving average, and then this blue one is a 200-day simple moving average. So that's what we watch. We do that because that seems to be kind of standard, though some people go with a 150-day simple moving instead of a 200-day. We go with a 200 simple, 50 simple, 21-day EMA, exponential moving average. So, and then these bands, these gray bands here, use the 21-day exponential moving average. Those are called the Keltner bands. If you don't know what those are, it doesn't really make a lot of difference. We have them just to kind of watch volatility squeeze in and expand out. So don't get too caught up on that. But anyway, ABM, back to a one-year view here. ABM, we're up 4.5% so far. We're fine above the 21-day EMA, and we'll be keeping it. So Bank of New York Mellon, we bought. Now, we, in the last few weeks, bought 3 banks. We bought one with the ticker symbol TFSL. We also bought Citibank, which is C. You'll see all of these. And then Bank of New York Mellon, BNY. Maybe I'll just go ahead and talk about all of them. So Citigroup, right here, C. We bought it. Now, here's something we have started doing that seems to be in concert with the way the market's going right now. We were finding ourselves getting stopped out at 7.5 because we use a 7.5% stop, and we work up or down from there, usually raising the stop, not lowering it. Sometimes we go with 2 times the average true range ATR. And then sometimes we'll back into the number of shares we want based on the stop that we're willing to do. What we've started to do, because it seems like there's a lot of volatility underneath the surface, but not on the surface, like we talked about in the market overview, what we started doing is getting real unforgiving on our stops. So we're starting to use like 2% stops instead of 7.5%, because if you think about the way your portfolio sheet ends up at the end of a quarter, you can actually have an array of anywhere from 1 to 2% stops and still make quite a lot of money. But a 7% loss, a 7.5% loss, especially if if it was a stop out and you actually had more than a 7% loss, because what we're trying to do is not have a 10% loss. If you get a 7.5% loss, you have to have something like a 9% gain in order to just get back to even. So what we've started doing is setting our losses somewhere between 1.5% and 2%, really, and even pulling the plug on some when they just don't work out. Citigroup, we got stopped out. Now, we got stopped out at a 1.7% loss because I believe we set the stop at 1.5%. We were just like, okay, if we're not nailing the entry on this, we're not going up. You can see we sold it at 135.82. Sorry, back to that other thing. You can see we sold it at 135.82 right there. See, maybe we need to get a little closer in. So 135. I didn't make the numbers any bigger. 135.82. The stock is now at 135. So we're down 82 cents. Not a lot, but it was enough. We were like, we're above the 21-day EMA. We're kind of at the 50-day EMA. If that stock takes off down this way, we don't want to do that. And so we just simply took a 1.7% loss. It was actually supposed to stop us out about 1.5. It did 1.7 because that's just the nature of stop losses. The other we bought was TFSL, which is a smaller bank. That one, it just simply took on a look we didn't like. The whole banking industry did this past week. I don't know what it was. In technical analysis, you don't have to know what it is. In fundamental analysis, you'll spend days figuring out what it is. And the truth is honestly probably somewhere in the middle. The truth is the stock's going down, so it just depends on how your brain works and how you want to do it. But we broke below the 21-day EMA and closed below it, and we went, we're not going to do that. So we pulled the plug. We pulled the plug with a 0.56% loss. And as you can see, we sold it at 1774 roughly. It's now at 1759, down a little bit. All of this could be a non-issue, and honestly, if it turns at the 50-day moving average and the whole thing starts going up, we will look at the banking sector again. That's fine. So I'm probably going to keep them on the list here for a little bit and pay attention. But the one we held on to is Bank of New York Mellon, BNY. It didn't swoon as badly as the other ones, but as we've mentioned in previous shows, Bank of New York Mellon does not have the same movement profile that Citigroup does. And TFSL is a smaller bank. I believe they're out of Cleveland, Ohio. So being like a small cap, I believe they are. They're going to move chunkily, even though they had some of the smoother small cap movement I've seen, but still they weren't BNY, I don't think. And so we're holding on to it. It is still above the 21-day moving average. We're out past earnings. It could well be that this is the exception to the rule. Yes, we are down 0.84%, but because of the size of it, what it was, the way it looked, the movement, we just kept it. So that's the way the banking sector worked out for us this week. And it was what it was. All right, so over to healthcare. CVS, we watched CVS before earnings, and earnings have become they're always dicey to start with, but in this market, we're kind of in the back of all investors' minds, at least ones that are reasonable, know that the market's overvalued and know that we're kind of getting into a bubble here, or bubble territory, arguable whether we are or what it is, but it's obviously very high. Earnings are just becoming a real trigger point, just a pressure point for the whole thing. And so we saw CVS duck below and close for a couple of days below the 21-day moving average. And we went, you know what? We have a small gain on that. Let's take it. Even if it surges upward, having a small gain would be better than anything else. Now, I would love to tell you that we were geniuses and just knew that this was going to go down. We did not. What we did was we made a judgment call based on the technical analysis we've been studying and just pulled the plug. So we made 2.4%, holding this for somewhere in the neighborhood of, a month and a half, almost 2 months sort of thing. Not the world's greatest return, but a positive return nonetheless. And so we did okay. Now, we'll keep watching it. It didn't seem like their earnings were particularly bad, but whether their earnings are good or bad is actually not all that relevant to where the stock goes in a technical analysis context. So we're watching it. We'll see if it turns down in here. This is the 200-day moving average way down here. So it has all kinds of room to turn and move and start heading back the other direction. And our nightmare would be a V-shaped recovery, where we get what Mark Minervini, I believe, calls a lockout rally, where it goes straight up way above the 21-day moving average and never gives you a chance to move back in, because it could do that. It'd go up hard one day and just never give you a chance to get back in. I don't suspect it will do that, but the stock market does a lot of stuff I don't suspect. So anyway, here we are. We sold CVS a little bit of a gain. Donaldson, we are up 10.18% on it continues. It's just riding the top of this Keltner band here. And again, if you don't know what the Keltner bands are, that's fine. Read about them if you'd like. We're probably not going to mention them all that much here on the TMC videos, but at the moment we have pretty nice strength. This is a technical indicator we watch. The DI plus is a little over 30. DI minus is lower than 13. And we are sitting at overbought territory on the RSI, where it's hit twice in just the last little bit. So we're okay with Donaldson. We're living large right there. Donaldson was DCI. Dollar General's DG. We're up 8.38%, still holding it. Technicals look good. RSI looks good. Still headed the right direction. Still above the 21-day EMA. Doing just fine. I probably need to do something like move this note somewhere that it's not in the way. All right, Duolingo. Duolingo is a little hard to see if you don't do something. Let me stick with it for 6 months for a second. All right. Historical volatility of Duolingo right now, if you can see that in the purple, is about 86, almost 87%. That is high. We have found it pretty difficult to make money off of a stock investment when a stock has that high of volatility. Now, historical volatility over a 10-day window is my chosen. Like if you use Thinkorswim, you can put any window you want on it. You just put historical volatility on there, and like I have it overlaid with the ATR, which is another. I believe Wells Wilder came up with both of them, I think. But anyway. With Duolingo, we sold that. I was actually in the, we're going to go to 2 months here. I was actually in the Portland, Oregon airport when we went offline. We got to check all this. And it was morning, and we had gotten to this top right up in here. Now, again, I would love to tell you that we just knew that from there it was going down. We did not. All we knew was that there was a plan in place, and the plan was that when it crossed this line down here and gave us a little bit of a move, we were going to buy and set our stop, which we did. And it was a close stop. It was another one of those 1.5%, 2% stops. We set it like that. And then up it climbed, and there we were in the Portland airport, and it was up here, and I was like, you know what? That is pretty high, so let's take it. We ended up with an 18.3% gain over, 4 trading days? It was something like that. Now, just so you know, that's not really our game at the 10 Mil Club, but if we can find one that we can do it, we're not beneath it. So we took that and did it, and it worked out well. I mean, even the potential type 2 error after our sale really kind of didn't materialize. We will show you that we did commit a type 2 error. Well, I'm sorry, it's actually a type 1 error, but we missed out in it as opposed to. So we'll show you another one that we did do that didn't work out so great. But this, when it dove back down here, we saw it. It wasn't like we weren't paying attention. We saw it. But the conversation went like this. That takes out this previous trend, previous swing low right here, that trough. You got peaks, troughs. They're referred to as swing lows and swing highs when they're talking about in a movement context. Peaks and troughs when you're just looking at them in a framed sort of charting context. That took out that swing low. And then it came back, and we went, here's the problem. Each of these spots here, and there are more back here, we're just showing 2 months. Each of these spots was a higher swing low, and each of these highs was another, I guess it didn't really do it right there, but it did here, which was a little bit of the gamble. There's something is imperfect about every trade we make. But anyway, we were like, that is a lower swing low, taking out that swing low, and its own earnings. And so we went, none of this stuff before really had earnings involved in it. And that combined with the fact that it took out the swing low. If it had just taken out the swing low, we might have bought it and come right back, we might have bought it. If it had something to do with earnings, but it didn't take out the swing low, we might have bought it. But taking out the swing low and being below the previous swing low to us was out of the mouths of 2 or 3 witnesses, that being 2 witnesses. And we just went, you know what? That's 2 points of data. I think we're going to pass. So still watching Duolingo, spend a lot of time on it. I know volatility is high. The thing is you can make a lot of money off that volatility if you can nail the entry. Again, our stops have become very unforgiving. So Fastenal we sold in the Portland airport as well. So let's take a look there. Fastenal went up to this level right here and then stalled. And so there we are sitting in the Portland airport going, we just sold Duolingo, we're like, okay, but Fastenal's not doing so great. And so we sold. Now, Fastenal, we had a gain of 6.9% over really just a week or something like that. It then did come down, turn, take off again. Nowhere near the gains we could have had if we had not sold at 47.40. So sometimes it works out and sometimes it doesn't. The truth of the matter is, if we're looking at 2 years of Fastenal here, that break higher, just in our view, with how it had been high and then didn't take out that swing high, did here but was ambivalent over here. To us, getting that kind of gain out of it, a 6.5% gain, the 6.9% gain, I remember the conversation was something like, it's, what is it? I don't know if Dave Keller said it, but it has been said on Dave Keller's Market Misbehavior web series by the people over on the right, which are hilarious. It's been said it's really hard to go broke making a profit. I'm sure that's not any of those people's words either. It's probably someone famous, and it would be nice to know who all these people were. Cataloged on top of my head, but in truth, I spend more of my brainwaves on trying to find actionable stocks and present them to you than I do trying to remember who historically said some kind of cute axiom. So there we are. We're going to keep watching it. We have a couple of alerts set back down here. Honestly, when you come back next week, Fastenal probably won't be on the list. I'm going to leave it right now, but it probably won't be on the list because it's too high now and probably would take a while to get down there. FDMT is 4D molecular. I'm going to leave it on 2 years for just a minute. This is the long bowl, and then it's not perfect cup and handle. Well, I guess this is the handle, but it doesn't really go up from the handle. This is a late stage drug development company, and they're developing a couple of different drugs. One of them's for lung cancer, and another one's for macular degeneration, I think. And anyway, they're in the late stages. You do have some share dilution and stuff, but you can kind of see a path toward what they're doing, and the market's recognizing it as well. And this turn, let me zero in on it just a little bit. Again, this is FDMT. This turn down here, we've got earnings coming up, So we would not be buying it before earnings. And the problem is it could shoot up after earnings, but again, it could also shoot down. And that's just the way the market is. So we won't be buying it before earnings. In fact, we would probably be buying it a day or two after earnings because we need to see a move up and a follow through day before we actually believe that the market cheered the earnings. So it's on here just for your information because we are watching it. GGG is Graco. We're up 5.15%. And so far, we're past earnings here. We bought it after earnings. There's the up. There's the follow through day. We bought it in the follow. Sorry. Yeah, we bought it in the following through day. A little early, but did so up. There's the decline and rise and the break above. And now, if you want to play around with Fibonacci numbers just for a second, I don't know if you believe in them. Many people say they're voodoo. Truth of the matter is they probably are, but you know what? It's the same voodoo everybody on earth is playing with, and that makes it true voodoo. So you have this retracement down to the 61.8% line, never gets all the way to the 50% line, then goes up and it didn't close above it, and that's the important point, is that it needs to close the day above it. But if it breaks above this 100 line, the next stop is supposedly this 161 line, which is about $90 a share, which would look good on our return sheet for the quarter. So we are in and we're holding it. It seems to have pretty good strength. The technicals are saying hang on to it. The RSI is up against overbought. It got overbought over here. And so everything's indicating to us that we should hang on to Graco. And I think I'll just leave the Fibonacci numbers on there. GIS, General Mills, we actually took a 1.09% loss on this because the stock couldn't figure out what it was doing. Had the stock, and this is how the conversation went, had the stock taken out the last swing high right there, we would still be holding that stock. But what happened was that the RSI never hit overbought power through here on any of these, and this high didn't take out the swing high. And so we went, you know what? And look, Mark Minervini, great trader that he is, says that he just sells things at market exactly where he makes the decision. I guess if your stock's falling fast, that's probably a good decision. On something like this, I go back and forth. We ultimately waited a few pennies one way or the other and sold it. But in truth, now it's at $36.89. We bought it at $36.66. We probably could have eked out a tiny profit on this had we just given it another day or two. And in truth, the money wasn't doing anything else. But you don't know that. And that last bit is the issue. You don't know that. It's everything you don't know. If we did know the future, we could be intergenerationally wealthy within 7 to 10 business days. But we're not. We don't know the future. That would be the holy grail, wouldn't it? It is curving like this, but we kind of went, okay, we'll just wait. I mean, it's still underneath the 200-day moving average, and as gets said on Dave Keller's Market Misbehavior web seminar a lot, or web series a lot, nothing good happens under the 200-day moving average. Well, that didn't stop us from buying it because we were like, that looks like it's turning, and it probably is. In a few years, it's quite possible that General Mills could do this whole recovery thing, and we will be on the train. So we're going to keep watching it. GSL Global Ship Lease is another one that we sold. We sold it for a 12.7% gain. We bought it down right at the, they call that the negative 50% regression line. We bought it right down in that area and held it for a while. And, we kind of gutted it out. And then up it came. And once it did this turn, we went, you know what? That is a new swing high, because here's the swing high and here's the swing high. This is 6 months. That's 3 swing highs. That was a new swing high, and off it backed. And we went, you know what? Well, let's take it. And so we did. We made 12.7% on Global Ship Lease. We'll continue watching that stock, but we are out. HCSG is back on the list because HCSG is back down in the lower quadrant of the regression channel that we have drawn. That's a lot of lines and a lot of garbage. I get it. But if HCSG shows us a turn down here in this little area, probably consider buying it this week. HP, this is the one that we did well with and the one that got away. So we got stopped out over here on HCSG. We thought we had a turn. It hit the 21-day moving average, did not respect it. We got stopped out. And that, so, 2485 to 2377 was a 4.34% loss. We must have, I don't remember, but we must have pulled the plug on that and just said, okay. And down it went, actually. And then it turned, Then it turned and came back, and we bought back right in this little area, right on the 21-day moving average. This is something we're trying to get better at. Human bias is such that it is easy to buy a stock, get stopped out, and then go, well, that was a negative experience. I'm never going to look at that again. We've done plenty of that. We've been guilty of it in the past. We are trying not to do that anymore. So we get stopped out of something, we watch it. We have actually made some pretty good gains lately on stocks that we thought we had an entry. They checked out with everything else. They stopped us out, and then we went, wait a minute. We're trying to decrease those losses because, again, you can take a whole sheet of 1.5%, 2% losses before you can handle just 2 or 3 7.5% losses or more. But we got stopped out over here, and then it returned, and then we bought it. So it got up here. Now, this little stall right here spooked us, is what it was, right there. Spooked us. And so just the other day, we did 2 things. We sold TFSL for that tiny loss we did, and we sold HPQ that morning. And in selling HPQ, we got a 19.3% gain, which by any measure is, well, any measure, which by most measures is a really good return. And then through the rest of the day, it was only Friday. The rest of the day, that stock went right on up and closed at 30.05, a new swing high. Closed at the new swing high. So it's both the stock that made us happy and the stock that got away. So, honestly, you're not supposed to do that. You're supposed to just go, well, watch it. You can always buy it again. And we will. We will keep it on there. In steel, IIIN is back on the list. We are waiting for an entry point down in this area, and is pointing toward one. We've talked about this one before and have yet to buy it, but we are now past earnings, and the market seems to be holding up. We should have bought it down in this area, but honestly got right here. This is late July. We just got busy and didn't buy it, and so it is trying to hold the day job and do this at the same time. We're going to be watching KinderCare a lot more. KLC. KinderCare, as you can see, it's quite literally $1.75 back over here in the last 6 months. Let me show 2 years of KinderCare. Right, so this is KinderCare. This is $30 a share. Now, I am a sucker for this kind of thing. I'm just going to be honest. In theory, if you read every trading book, really what they want you to do is find something with upward momentum and go with it. And it's totally okay. You need, good number of months of upward momentum and all that kind of stuff. In truth, you can adapt that to value and recovering investing too. And that's what KinderCare is in the process of doing, is to dump, and then all of a sudden right there, there's earnings, pow, and people are $1.75 a share. Now they are $5.17 a share and headed to another set of earnings. They have new leadership, is my understanding, and probably are a stock worth owning over a long period of time. This may be our entry point. I don't know. We will have some conversations early in the week as to whether we should buy this before the earnings or not. The problem is the earnings could tank it. The earnings could recover it. I mean, look, they're not in sad shape, right? But they lost their growth, and that's what like. But look at this. This is, let me just divert a little bit. This is Leslie's Pools and Spas. All right, 2 years of Leslie's. So back over here, Leslie's is quite literally $72 a share. And then down it goes. Then they have to do a 1-for-20 reverse split just to simply stay listed. Let's go to 6 months here. LESL is what this is. And then all of a sudden they have these promising earnings right here. Oh man, and up it goes all the way to $10 a share. And then all of a sudden, without warning and not knowing exactly why, they just turn and come back the other direction. That probably was shorts covering, to be honest. But it was also, pile in. And look, a run from $1.70 or so in mid-May to over $10 in late June. I mean, that is stratospheric. Of course, that's everybody's dream, right? Especially on like penny stock millionaires and stuff like that. Wall Street bets. That is everybody's dream, is to find something for $1.75 that is going to 10. That is rocket, rocket, rocket to the moon. Diamond hands, diamond hands. That's what that is. Finding that is really, really hard. Finding it and then riding it is almost equally as hard, because you have to know where to get out. The funny thing is, now they have announced that, down, 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 down. And somewhere in here they announced, maybe on that down day, sometimes not, they announced that they were considering Chapter 11 reorganization bankruptcy, because that'll be the best thing for all parties involved. Well, it's the best party for all parties involved, except for the equity holders, who will lose all of their money. But they never mentioned that. So anyway, KinderCare is probably not in that situation. This is a much longer. We don't follow a lot of penny stocks, just simply because we have to have a special reason. This one, though, I found, and it has a lot to like. So we're gonna do it. All right. I put McDonald's on the radar. Let's look at two MCD. Let's look at 2 years of it. Up, 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 then down. Right. It's not like their earnings were horrible. They are having to do a little bit of kind of bringing the company back from inflation problems and things like that. But this could easily go up quite a bit. Now, we haven't just bought it. Earnings were here. They didn't seem to be too terribly bad. But what we're waiting for is higher swing highs and lower swing lows. We have a higher swing low right there, just for the earnings. What we don't really have is a higher swing high. And we would buy on the next swing low with the turn. So we're watching McDonald's, but not doing anything with it yet. Medtronic, MDT, we are at the 21-day EMA. Bear in mind, this regression channel is far more subjective than the 21-day EMA, which itself is somewhat subjective, but is calculated. The regression channel's projected out into the future, whereas the 21-day EMA is actually an exponential moving average of the movement of the stock itself. So more reliable will be the 21-day EMA, and we are right at about that. So we may be buying Medtronic in the next few days. NEXN, we are still waiting for a turn down. We just simply didn't catch it on these closer points to the 21-day EMA. But give us another one, we'll do it. PCTY is in what is almost a lockout rally. This is the 21-day EMA, and it is going right on up. We may have a conversation just to go, hey, look, should we buy this and just set a close stop? Because if it goes right on up, it's, you can just see it. Let's go with 2 years here real quick. So, here it is down, and then all of a sudden the market just goes, I love that stock, and up it goes. And from a technical standpoint, when you got this wide DI plus DI minus gap, you have overbought RSI, you have your past earnings, markets cheering it. It might be time to actually just dive into it, but we would set a pretty tight stop on that. That'll probably be one of our 1.5% to 2% stops, full show. Progeny, Progeny was a problem from the moment we bought it. PGNY. We probably bought it a little too high because it was, let's see if we can zoom out 6 months. Let's go with 3 months here. 3 months, 1 day. There we are. Okay. Here's the 21-day EMA, always in burnt orange on mine. We bought it right there, which is a little too extended from the 21-day EMA. And this stock actually taught us to watch that more closely. And that was only a few weeks ago. This is how fast our evolution is now kicking into gear. That's way up off the 21-day EMA, right? If we had wanted to buy that, we really should have set like a 1.5% loss or something. As it turned out, we didn't turn out so badly. What happened was it just simply headed toward earnings. It just kind of like this and ground along for only a few days after we bought it, where we even up for moments. And then we were down most all the time. So what we did was we pulled the plug on it a few days before earnings, right there, as most of the world was doing that was, trying to actively manage a portfolio, and it turned out to be a good thing. Now, this is a quite a dead cat bounce. I mean, it opened around here at 25.50 and closed somewhere back at 28. I didn't think their earnings were particularly bad either, but again, it's a jittery market. And so with a gap down like that and not filling the gap that day, we kind of feel justified. We'll see. Of course, the technicals flipped, right? Because that was quite a day, and it was a lot of really heavy volume happening. I guess the earnings were after the market closed. And so let's see here. After market. So this is the following day right here, the big day, and the gap down, and then all the volatility, and just good to be out of something like that. And so I wish I could tell you that we knew that was coming. We didn't. We just pulled the plug based on what we had experienced from the technicals. And anyway, moving on. PRGS, Progress Software. Probably need to see a bit more. So this is 2 years of Progress Software. Now, AI is going to destroy the whole world of software. That was the whole cry in the hue. Down, 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 and then it crosses, and then right here, and we have some earnings, and the market cheers them, and up we go. That one we may have to actually buy into with it extended a bit over the 21-day moving average. And you're probably thinking, but we just looked at Progeny, PGNY, and you bought it too high over the 21-day moving average. We did. But we did not have that kind of upward pointed, RSI upward pointed. Let's go back to it, PGNY. So when we bought that right there, the DI plus was beginning to decline. The DI minus actually began to increase shortly after that. The RSI was overbought at the time. Relative strength had been real high. Kind of talking myself through this. Progress Software, though, right now doesn't have a lot of that. It still has an upward sloping RSI that isn't quite into overbought territory yet. And this gap is actually widening. So it's a gamble, whether we take it or not. But being that far off, what I'd love to see is a return to the 21-day EMA right around there. And that may actually be the way we go, because we have a lot of conversations and settle on things that I would not settle on myself. Range resources we still have, RRC. I would expect that this would go up. We're down 3.04%, and again, we bought that a bit over the 21-day EMA. We have not been stopped out on it. Our stop isn't too terribly low. It's been kind of respecting the 21-day EMA. The last few days of last week, it seemed like there was peace in the Gulf of Hormuz. Now there's not going to be over this weekend, and so I'll bet you that stock's probably going to go up on Monday. And we're still holding it. The fundamentals on this company are quite good. I mean, they really know what to do with money with respect to their capital stack, buying back shares, improving operational efficiency, paying off debt. They really know what to do with it. And so, we're keeping them for the time being. It's just you can see the volatility kick up here. And when I say kick up, the historical volatility, the purple line right there, is 37%. Not huge, nowhere near the level of a Duolingo. Of course, it's not a tech stock. But you can also see it rise from this period back over here when we bought it. It was about 20%, and it's risen from there to the 37, a little over 37% it is now. We're still holding on to it because we just never know what's going to happen in the Gulf of Hormuz. So, and that company just really has great fundamentals, so hanging on to it. SCI Service Corp International. We sold this. If you're looking at 2 years of it, it looks like this. It's such a slow uptrend that you have to rely on the arm of flesh to kind of get the job done. And remember, we did this in 2 different steps. Let me go to 1 year here. We did this in 2 different steps. It went down to this area right here, and right there at the bottom, we cleverly bought it, or so we thought. Now, at that point in time, we were still setting 7.5% or 2 times the ATR stops, and we got stopped out. Bing! However, we had evolved enough to know that we needed to keep watching the stock, and we couldn't understand why it had gone down so low. It went down, it hit this point down here, and on the way back up, we rebought, and we sold that just a few days ago at this technical resistance high of at a 15.6% gain. After this 7.5% loss. So you're supposed to think of these things in terms of them being their own trade. In theory, what we should do is try to nail this entry a little better, tighten the stop up, make it 2% or less, and then a 15.6% gain feels a lot better. So, but anyway, we sold it, and as you can see, let's go to 6 months here. As you can see, since we sold it, so we sold it at 85.70, it's at 85.01. It's still up in that area, but it's not exactly showing the same power it was. And the DI plus is starting to let off. Now, it can do any of a couple of different things. The market can tire of that, and it can go right on back down, in which case we would buy SCI again. Or it could dry up and then break out. Now, if it breaks out above and takes off, we'll be in, but we just don't know where it's going, so we had to kill it. Sirius satellite radio, and if you are thinking Sirius satellite radio, why don't you buy Sirius satellite radio for? What I posted on the Facebook page this week was, your mother called and wanted her satellite radio back from 2005. Thing is, if you run their fundamentals, they actually are pretty good. They're keeping they're kind of bringing their debt down a bit. They're buying back shares. They're now past. There was a big merger that they had with the Liberty tracking shares year and a half ago or something. We're kind of past those doldrums now. You can see the doldrums here, right in this little area, down. Berkshire Hathaway's been buying blocks of it periodically. Shouldn't necessarily buy it just because somebody else does, especially someone as big as Berkshire Hathaway. They can do things that you can't do, but they've just been buying blocks of the shares. And so with the improving fundamentals, and there's also a line of thinking with this, they were having to replace a lot of their satellite hardware. I believe some of the satellites themselves, and it was costing them a lot. I believe they're past most of that now. And so with that being the case, Sirius is getting rewarded. We are down 1.77%, but we only bought it a few days back in last week, and it just kind of took a swoon down this way. Now, it is below the 21-day moving average. There is that. So we shall see, but our stop is set at 29.23. And honestly, stops out tomorrow morning, but we won't take a 7% loss. All right, our mascot stock, TMC, the metals company. The only comment we've gotten in a long time on the 10 Mil Club's videos was from someone who commented on my comments 2 weeks ago about this stock when I called this a junk stock. Not going to take that back, but I am going to say this. The comments, which I won't pull up and read to you here. First of all, though, thank you very much for watching our video. And if anybody out there wants to make a comment on any stock, we'll certainly take them and answer you, in a very well thought out, as well as we can manner. But the comment made it sound like the person kind of took some offense to the fact that I called it a junk stock. Well, I don't know, maybe that's a little coarse, but here's the deal. It is rising into earnings, all right? Earnings are this week, August 13th. Today is the 9th, all right? So August 13th, or they're this week. You just never know what earnings are going to do. This stock has sunk and sunk and sunk and sunk and sunk. It has done, the stock itself, if you bought it, has done absolutely nothing good for you and really mostly bad for you over the past 2 years, right? This person's contention was, well, I mean, honestly, I think that this stock, if everything lines up right, they said that, if everything lines up right, this stock could surge and give me back all of my losses. Okay. You know what? Far be it from me to cast the first stone. I used to do that very same thing. I used to go, well, hey, it's a cheap stock, and one day my ship's going to come in on that stock. We don't do that anymore here in the group. And the reason is because what we're trying to do is nail down a consistent way to invest that will give you market-beating gains. Now, to be perfectly honest, over the past few quarters, we have not beat the market. We're doing pretty good this quarter. Doing pretty good. We're doing better in the most recent month, than we have in quite a long time, and some of it is just our ruthlessness with stops. But picking stocks like this, where we don't know when they're ever going to make some revenue. Now, they should make some revenue this time around, and I bet you that's why it's going up into earnings. They did buy some royalty rights to an iron mine in northern Minnesota. They did do that. And so that's probably why it's going up. There's an expectation that they're going to have some revenue. It'll be the first revenue they ever have, and so the stock should shoot up. But that's a high-risk thing, because what happens if we get over there and they have a little bit of revenue, but like the market was expecting a lot more revenue and it goes straight down? Just buying something like this isn't a consistent way to try to beat the Standard & Poor's 500. If you can't beat the Standard & Poor's 500, which takes a lot of work, and that's what we're trying to do. We're trying to put in that lot of work. If you can't beat the Standard & Poor's 500, the best thing you can do is just put your money into broad market ETFs, mutual funds, and just get back to work at whatever it is you do that does make money. We have decided here not to have a wealth manager and spend our time learning how to drive our own car, so to speak, as opposed to being chauffeured around by a wealth manager. We've decided to learn how to drive our own car. And by so doing, we have figuratively hit plenty of trees and driven over plenty of curbs. But the scenery is getting a little better. And we're starting to pick up just a little bit of speed. So it's kind of nice. But buying something like this isn't the way to do that. We don't know what's going to happen on these earnings. Maybe it'll shoot up, and maybe it'll end up right up here at $9 a share next week. Maybe the market will rise to that point. It'll be just a little bit of revenue. Everybody will be disappointed, and it'll be $2 a share by the week after that. That's so much volatility that we just don't know what to do with that. And so we watch this only because it's our mascot stock. It's TMC. The ticker symbol's TNC for TMC, the metals company, and we are TMC, the 10 Mil Club, and so we watch it as our mascot stock. But that is the only thing we watch. Really quick, two stocks. We are starting to watch T-Mobile, TMUS, and the reason is because, look at it for 2 years here. You have down, 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 and this line that you see down here, admittedly, trend lines are arbitrary, but that trend line is also, it just goes back several years, and yes, the stock is underneath the 200-day moving average, but the market appears to be able to see that trend line as a resistance level. Now, it could go right on down. It is underneath the 200-day moving average, and it is underneath the 50-day moving average, and so we're not buying it right now. It may sit on this list, or maybe taken off the list for some weeks that I have too many things to talk about, but T-Mobile is starting to watch. Probably not buying it this week. And finally, WLY, John Wiley & Sons, has really good momentum. I really like the fundamentals on this particular stock. And anyway, right here at the 21-day EMA, may be buying that just as soon as Monday, depending on whether it gives us an entry. And that is the way we see it. From all of us at the 10 Mil Club, thanks so much for watching, especially our singers Sophie, Hannah, and Presley, and our announcer Jackson. And we will see you next time on the
10